Hi, everyone. I'm Nate Ekman. I'm an analyst here at ValueLine. I'm joined today by three other senior analysts, Alan House, Sharif Abdu, and Charles Moran. Today, we're going to provide an update on the economy and stock market. We'll then recommend one stock to buy right now, and finally, answer any questions you may have. Please note that this presentation will be available on our website, www.valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at ValueLine. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the ValueLine Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by ValueLine's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, ValueLine has no investment banking business with any company, including all of the equities under our coverage. ValueLine does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-ValueLine. Now, let's discuss the economy and the stock market. This content was prepared by ValueLine's economic staff. Inflation showed signs of cooling last month. The Consumer Price Index, or CPI, increased a modest 0.1% in May. On a 12-month basis, the CPI was up 4%, again matching expectations, but down notably from the 4.9% gain registered in April. This figure also marked the 11th consecutive period of slowing price growth and was less than half the peak reading of 9.1% recorded in June of 2022. The core CPI, which excludes the food and energy components, was up 5.3%, suggesting inflation remains sticky in some areas of the economy, particularly the services sector. The May Producer Price Index, or PPI, also showed moderating price growth at the wholesale level. Specifically, the PPI declined 0.3% after rising 0.2% in April. On a 12-month basis, producer prices rose 1.1%, which was down significantly from the prior month reading of 2.3%. The Federal Reserve took a pause on the interest rate front at its mid-June Federal Open Market Committee meeting. No new rate hikes were announced, although updated projections from the Fed suggest that more may yet come before the end of the year. The cooler than expected May prices likely gave the central bank an opportunity to examine how much of an impact the most restrictive monetary policy course in 4 decades has had on the economy. The resultant tighter credit market, which has reduced lending activity as banks turn more cautious, may well do some of the work for the Federal Reserve in its attempts to slow growth and tame inflation. Sentiment is growing that the Fed will be able to orchestrate a soft landing for the economy. Although manufacturing and home building activity remains weak, inflation is moving in the right direction, while job creation remains healthy. The consumer has also proven resilient. That said, the continued inversion of the Treasury market yield curve, the weakening leading economic indicators, and mostly lower oil prices still suggest at least a mild recession is plausible later this year. In conclusion, the equity market rallied nicely in the first half of June, fueled by moderating inflation data and the debt ceiling deal. Still, some roadblocks exist in the market's attempts to sustain the rally, including slowing economic and corporate earnings growth and some uncertainty about the Fed's course of action in the second half of this year. Please refer to the inside back cover of Selection and Opinion in the Value Line Investment Survey for our statistically based asset allocation model's current reading. On that note, Value Line provides a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, Value Line offers a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website, which once again is www.valueline.com. I will now show you how to access those reports. Once signed in on the website, head to the dashboard, where I am already located. This is the main landing page for subscribers. Under the Quick Links section, click on Supplementary Reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to improve liquidity over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among many other issues. Due to the changing structure of company balance sheets, Value Line has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those that don't know, financial strength, along with price stability, another proprietary Value Line measure, are the two metrics that are used to calculate a stock's safety rank, which is a key measure of risk. When considering a new stock to invest in, we strongly suggest you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. Now, let's move on to the one stock to buy right now. For this, we'll go to the screener, where we already are. Value Line subscribers have access to 15 preset screens and 50 fields for screening stocks. I should also mention that another 100 or so fields are available, but require a higher level of subscription. If that interests you, please call 1-800-VALUE-LINE. As noted in our economic analysis, the current environment remains uncertain, with the possibility of a mild recession still on the table. As such, we'll be looking for stocks with an average or better risk profile and strong returns potential over the long term. We'll start the screening process by looking at the safety rank in the Ratings and Ranks section. There are many risk measures to consider, but today we're starting with safety, which measures the total risk of a stock and is arranged on an easy-to-understand scale from 1 to 5, with 1 being the most conservative issues. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. They also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education of our section of our website. For this screen, we're going to focus on stocks with a safety rank of 3 or better. By applying that first criteria, we've trimmed away our potential candidates down from 5,700 to 2,024 candidates. Next, we're going to filter for timeliness, another of our tried and true measures. Timeliness is another proprietary value line metric that evaluates a stock's projected price performance in the coming 6 to 12 months. Like safety, it's a straightforward scale from 1 to 5, with 1 being the highest. Today, we want a stock that will keep pace with the overall market over the short term, so we're looking at stocks ranked 3 or better. By applying that screen, we've trimmed the list to 869 candidates. Because we'd like to find some names that are a bit below the radar, we're going to focus on mid-cap stocks this time. These stocks have market capitalizations between 2 and 10 billion. Applying this filter, we have reduced our opportunity set to, just give it a minute to type in, and there we go. We've reduced our opportunity set to 335 stocks. Next, we'd like to select a stock from an industry that is expected to perform well in the immediate future, which is measured by the industry rank. Value line industry ranks function similarly to timeliness ranks, but rather than comparing the relative price performance of individual companies, they compare the relative price performance of industries as a whole. Of the 98 industry ranks, we have chosen the top 20. By applying this criteria, we've cut the list down to 22 candidates. Finally, we want a stock with strong potential returns over the long term. This figure is derived from analyst projections of cash flows, earnings, and terminal valuation over the next 3 to 5 years. For today's selection, we would like to have an annual potential return of 25% or better. Our list is now down to just 9 possibilities. You can make a strong argument for any of our remaining candidates, and investors interested in adding new positions should consider them. However, only one can be today's one stock to buy right now, and after consulting with a number of our senior analysts, we prefer and recommend Premier Inc., ticker symbol PINC. Before I click on Premier, please note that screens can be saved and revisited by clicking the Create Saved Screen button at the top of the page. Now, let's click on Premier and get a look at our latest full-page report. Premier's primary line of business is as a group purchasing organization, or GPO, for the healthcare industry, which helps healthcare providers save money on drugs and equipment by bundling orders together. It also provides technology, consulting, and other support services for the healthcare industry. As you can see in the statistical array, which is the area in the center of the report that includes the financial data, the company experienced a massive spike in revenues in 2021 due to the COVID-19 pandemic, even as net profits declined due to the added supply chain expenses that it caused. Since then, the company has seen a pullback in both revenues and earnings as it attempted to navigate the post-pandemic environment, which has helped to keep the stock price relatively flat. However, margins have already returned to their pre-COVID levels, and we expect results to turn around in the coming quarters. Meanwhile, the company's fundamentals remain solid with an A+ rating for financial strength. All of this, we believe, constitutes the groundwork for excellent potential growth over the coming 3 to 5 years, with projected annual return potential of 29% at the high end. In terms of other investment merits, the stock holds a safety rank of 2, above our minimum rank of 3, and offers 18-month price appreciation potential of 20% above the recent value line median of 16%. Now, these factors alone are not the sole reasons we have chosen Premier as our one stock to buy right now. In May, the company announced that it was exploring strategic alternatives, which in layman's terms generally means that it's seeking to sell itself. Last week, Premier announced that it had divested its non-healthcare GPO operations for the sum of $800 million. We believe that this was another step towards a sale, with the company making itself a more appealing acquisition target by reorganizing into a pure-play healthcare support company. Thus, Premier presents something of a win-win scenario. Should a deal materialize, investors would stand to make a premium, but even if one doesn't, they still stand to benefit from the stock's strong long-term return potential. That's what makes it today's one stock to buy right now. We will now tackle your questions. Please note that we typically can't answer complex questions about specific stocks on the spot. For this, I recommend a review of our latest reports. The first few questions were submitted prior to this presentation. Now, I'll hand it off to Sharif and Charlie.
Thank you, Nate. Okay, let's take a look at some of the questions that were submitted. Let's see, Margot Taub submitted one question. She's asking, in the Legends box, the value line is defined as a number times cash flow per share. So she's asking, where does that number come from? I think she means the multiple that we use. Also, what is cash flow per share? Alan, if you can make the value lines, the report a little bit bigger so we can get the Legends box nice and big. That's perfect. Thank you. So I think what Mrs. Taub is referring to in the Legends box is the 12.0, which is the multiple that we're using for cash flow. So I'm going to take a step back. So to come up with a cash flow multiple, there is some trial and error involved. We start with the average annual price for that stock for each year going back many years. Okay, we then divide the average annual price for each year by the cash flow per share that the company generated in each of those years. So, for example, if we're looking at Premier, let's start with 2014. We see that the cash flow that the company generated was $1.53. So it's $1.53 in cash flow that it generated. Now, something that you can't see in this report is the average annual price that, for the stock for that year, for 2014. That is something that we have in our database. We have the average annual price for all stocks in our database going back many, 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 many years. But you can actually approximate the average annual price just based on this report. You don't even need our database. You can just look at this report and kind of get a general approximation of what the average annual price is. You do that by looking at the high and low price for that stock for that year. So, for example, here for 2014, we see that the high is $38.90 a share. We see that the low for the year was $26.50 per share. You do the calculation. I'm just doing it off the top of my head here. So let's say 40 and 25, 65. So it's roughly, what is that, $32.50 per share. Let's say that's kind of a rough approximation. It's not exact, but it gives you a pretty close approximation of what the average annual price for the shares were for that year. So you can kind of do that calculation for every year. You can get up the average annual price, and then you can look at what the cash flow per share was for that stock for each year. So 153, 176, $2 in 2016, 234 in 2017, and so forth. Okay. So once we know what the average annual price is, and once we know what the cash flow per share is, we then divide the average annual price by the cash flow per share. Most people, I'm assuming everyone who's attending this webinar, you're probably familiar with what the PE ratio is, which is the price-to-earnings ratio. That's a commonly used valuation method. In this instance, we're looking at the price and cash flow ratio, okay, that the company has generated over its recent history. So let's say a period of 10 years, okay, and we calculate the average. We then back-test that number. We back-test the cash flow multiple that we just calculated, and just to see if the valuation holds true over time. There is, like I said, a trial and error involved. Okay, we tweak the number until we settle on a cash flow multiple that is accurate. And in this instance, for Premier, we went with a cash flow multiple of 12. Okay, so we feel that if you want to be forward-looking now. We have a projected cash flow per share for Premier for 2013 of $3.30 a share. For 2024, it's $3.50 a share. So you would multiply that cash flow number by 12, and that should give you a ballpark figure of what the shares should be priced at. Okay? Now, Margot also had another question. She also asked, what is cash flow per share? Okay, this one's a little bit more straightforward. As far as cash flow per share, first, let's define what cash flow is. The generally accepted definition of cash flow is net profit plus depreciation. Okay, net profit plus depreciation. Technically, you would add back all recurring non-cash expenses. So that would be depreciation, amortization, and depletion. 9 times out of 10, your primary concern is depreciation. Okay, you're not going to have to worry about amortization and depletion, which are they're similar to depreciation, but the one you're going to be looking at most times, 9 times out of 10, is depreciation. So to calculate the cash flow, you're going to add net profit plus depreciation, then you're going to divide that by the number of shares outstanding. Now, the reason that we are adding back depreciation is because it's a non-cash expense. It's an expense on paper only. No money or capital is actually exchanging hands. So it doesn't directly impact the company's cash position or its financial standing. That's why depreciation is usually added back in the calculation of cash flow. Okay? So like I said, you take net income plus depreciation, then you divide it by the number of shares outstanding, and that's cash flow per share. I hope that answered Margot's question. Charlie, anything jumping out at you? Okay, I see another question here. Michael Silver asked, on your standard reports, there's a box in the top left of the page. It includes timeliness ranks and technical ranks. What's the difference between the two? Sometimes the numbers are not in perfect agreement. Why is that? So, Alan, if you want to scroll up to the top of the page, thank you. That's perfect. So we see, for example, Premier. Now, this report is from, I'm assuming, maybe several weeks ago, maybe a month ago. I don't know the exact date. The timeliness ranks for this.
Yeah, this report is from about.
Oh, June. Okay, so
it's recent, but the timeliness rank has gone up since then.
Okay. Yeah. Okay, perfect. So, Alan, if you want to go back to the top left of the page there, so we can show our participants. Okay, so let's say the timeliness rank right now was 3, which is what it currently is, and the technical rank was, let's say, it is a 4. So what is technical rank? What is timeliness rank? So I'll give you what the textbook definition is according to Value Line. So Value Line actually has several proprietary metrics that we use to evaluate stocks. Probably the one metric that we're most commonly known for is timeliness, okay? That's the stock's probable relative market performance in the next 6 to 12 months, okay? It's basically a projection of how we believe the stock is going to perform in the next 6 to 12 months relative to the market. That's the important part to remember, relative to the market. By contrast, the technical rank is the estimated stock price performance relative to the overall market, but it's only the next 3 to 6 months, okay? Technical rank, 3 to 6 months. Timeliness rank, 6 to 12 months. So it's a little bit more kind of fine-grained way of looking at stock price performance. Technical rank, very short term, 3 to 6 months. Timeliness rank, let's say the short to intermediate term, 6 to 12 months. So both ranks are presented on a pretty simple scale of 1 to 5. Stocks that are ranked 1 or highest are expected to be the strongest performers. stocks that are ranked 5 or lowest are expected to be the weakest performers, and stocks that rank 3 or average are expected to mirror the market in those respective time frames, okay? Now, Mr. Silver also had the follow-up question is, what's the difference between the two? And sometimes the numbers are not in perfect agreement. What we're trying to do really with these ranks, we're sort of trying to, I don't want to say thread the needle, but the reason why the ranks may not always be in perfect agreement is there may be a hurdle for the company to clear, maybe in the very short term, but if you stretch the time frame out a little bit more, we think that the stock will perform a little bit better. That's why the ranks aren't always in perfect agreement, okay? Let's see what else is jumping out at us. Any other questions have been submitted? Let's see.
I saw one
Charlie,
from William. Yeah, can you hear me now? William, he had a question regarding the target price range. In some cases, it's very narrow. In some cases, it's very wide. And that is a function of calculations. We can't really divulge the specifics behind that. But in this case, it's between 70 and 55, the 20 to 26 to 2028 projections. Typically, when a company is deemed to have when it has a higher safety rank, the target price range will have a narrower expectation 3 to 5 years hence, and when it has a wider safety rank, a lower safety rank like 4 or 5, the projection range, the target price range 3 to 5 years out will be much wider. So that was one question. I hope that is answered. Another question from Paul was a question regarding the 3 to 5 year multiple and how that is calculated. In this case, for Premier, it kind of gives you a good indication of how it can differ from 2017 to 2022. It has been in the high teens as the company's matured. Prior to that, it was above 20, but in 3 to 5 years out, the PE multiple is 15. It is calculated, it's subjectively determined by the analyst, but that can be a function of how the capital structure is now relative to the past. It could be a function of the recent PE ratio. As I said before, from 2017 to 2022, it was in the teens, and this is kind of a good average of the past 5 years. But it can also be different than in the past, judging due to how the analyst perceives it will grow or not grow in the future. But again, the main thing to remember is that is not a calculation that's automated, but is a function of what the analyst has determined going forward. Anything else? I see a follow-up question kind of tangentially related to the question I just answered earlier. David Sofair asked the question, timeliness is 4 on the company sheet. So I'm assuming he's referring to the PDF that we're displaying on the company sheet, but we screened for timeliness of 1, 2, and 3. So as I touched on a minute ago, this is kind of a blessing and a curse of Value Line's system. The timeliness ranks for all the companies in our database are updated weekly. So this is not a static number that just sort of stays in place. We update the timeliness ranks every week. So, for example, Premier went to press June 2nd is the publication date on the bottom of the page. It was a 4 at that time, but it is now currently a 3. So it actually has moved up in timeliness from a 4 to a 3. That's why sometimes, we're screening for 1, 2, and 3. On the page it says it's a 4, but the stock is actually currently a 3 on our timeliness ranks because, again,
The timeliness ranks and the technical ranks are updated on a weekly basis. Let's see, any other questions that are jumping out at us? Charlie, anything interesting?
No, that seems to be about it, all I can see.